So today's Cardinal lesson is the first lesson of 2024, and we're talking about 2024 retiree tax rates, brackets, and exemptions. So these numbers change every year in the end of November, sometimes beginning of December. Um, Out comes from the Treasury, all the new brackets. The rates stay the same, but the brackets increase. The long-term capital gains brackets increase, the estate tax, there's an effect on the standard deduction. All that stuff is published. And we're not really here today to just give you the new numbers because you could look them up if you wanted to without a lot of trouble. What we're going to talk about today is we're going to talk about what the new brackets are, but more importantly, how we apply this, how we use this information, why we study this to your benefit. So I want to bring Tom on. He's going to talk about why we're doing this 2024 tax bracket, tax rate, retiree exemption video.
Yeah, I think taxes can be one of your largest expenses in retirement, especially if it's not planned well. And you can eventually just rob from your inheritance. You can rob from your future self, can really deplete IRAs very quickly. And so we really want to use these brackets now to do some planning today to avoid really higher amounts in the future. And so we're going to walk through these numbers, give you some you know insight on how we use them sort of piece by piece. I'm going to bring up the show notes here where you can see a little more details of what's on the board. You can find these at the link below our video. They're also on our website under the show notes section. But we have the board, and then this is really the document that the Treasury releases that talks about all the changes in the amounts of the taxes. Sort of like John Hans was saying, the percentages haven't changed, but the amounts, the size of the brackets have changed a little bit. So if you really want to dive in deep into all these changes, go for it. We've highlighted sort of the pieces that we have on the board, so you can find these in the show notes. If you have questions, give us a call. But this is just public information talking about the changes in the tax rates for next year, for I guess for this year for 2024.
Okay, so where we're going to start is on the left side of the board. The top part is the tax brackets and the marginal tax rate for the year. And so, how do we use this? I mean, by January, February, March, Aprilish, Tom and I really don't need to refer to this chart ourselves because the key bracket numbers and indicators we've already got in our head. So I'm going to bring Tom on, and he's going to talk about, we talked getting ready for the show, is where do we use this the most, Tom?
Yeah, these sort of marginal tax brackets we use mostly in our practice when we're planning Roth conversions. And we have lots of videos where we talk about this, but that's where you take money from your traditional IRA, pay taxes on a portion of it, and convert it over to a Roth IRA. And so a lot of times we're targeting certain tax brackets to do so. And so we need to know where these brackets are because we're filling them up. So we'll look at your income. Let's say we have a married couple and we're targeting the 22% tax bracket. We'll go through and we'll look at their income. Maybe they're making $100,000 from other sources, pensions, Social Security, living off some of their IRAs, whatever that might look like. And now we have essentially we go to the top of this tax bracket. There's 201,000 that we can earn and stay in that 22% tax bracket, and we'll fill that up with Roth conversions. It's a little more detailed than that. Don't go try it on your own. Help use someone who knows how to calculate all this. But we need to know what these numbers are because we're doing it in Roth conversions. One point I want to make when we're just on this marginal tax bracket part is, and this is often confused, most people, you go out and ask them on the street, they don't really understand this, is you actually get to fill up these brackets as you earn money. So if we have a married couple, the first $23,200 they earn is taxed at 10%. So even if you go to the next tax bracket up, let's say they actually made $25,000. Well, it's only the additional $2,000 or so that's taxed at the 12%. So you fill them up and you get to pay those lower percentages on the first dollars you earn. So even if you fill up the 22% tax bracket, you're not effectively paying 22% taxes on all that income because about half of it, a little less than half of it, is taxed at either 10% or 12%. So that's just important to know because some people will say, well, I don't want to earn another dollar and go to the next tax bracket because I'll get less money. And that's just not how the tax brackets work.
No, and even if we make a little mistake in calculations and we went over the 201,050 in a Roth conversion, let's say we went over it by 5,000, well, that additional 5,000 is all that's going to be taxed at 24%. So it's not a huge penalty for being wrong. And it just brings up a point. When people start looking at other videos we have, and then when people are sitting down with us and we're making decisions about Roth conversions, and they see what's going to happen in 2026 to these brackets and rates when the Tax Cuts and Jobs Act sunsets, all of a sudden somebody that's willing to accept a 22% tax rate takes a look at another 180,000 if they could accept the 24% tax bracket, because you really only got 2 years left. You got 24 and 25 to enjoy these low rates. And so we're going to have people, and we've had this with a lot of clients, that are going to go up and they're going to say, well, I can stand 24%, so I'm going to do a lot more this year and maybe next year, and then back off from it when tax rates go up. So this is really important to us. And then we've only focused on the married people filing jointly, and we got single people doing the same thing, and the brackets and the hedge points are a lot lower. So that's a big place that we use it.
And I think we also need just to point out on the single tax rates. This is another place we use this is when we're looking at planning for the rest of your retirement, and we do have a couple. It's a pretty good chance that one of you is going to pass before the other. We don't know who that's going to be. We don't know at what point that will be. But normally, one spouse will live past the other, and now they're filing taxes at the single tax rates, and you can essentially you get to those higher brackets twice as fast, right? You get there much more quickly as a single tax filer. So that's another benefit of doing something like Roth conversions, where we're intentionally paying taxes now to avoid higher taxes in the future.
Oh, that's really hard on a widow or widower in their 80s. That's when minimum distributions really kick in gear. And earlier, their spouse was alive and they were married filing jointly, and they had minimum distributions coming at them that they had no control over, paying a lot of tax. That gets even worse when the first person dies, the other one lives on. The minimum distributions are the same because the money's still there. It gets pushed out, and now the taxes get paid at these higher rates. So it's definitely something worth planning for. Another point I want to make with this is that it seems like the top of the 22% bracket every year is pretty close to the IRMA Medicare surtax limit, the point at which you start paying IRMA. So for 2024, if you're a married couple filing jointly, and you're under 200 grand, you're not going to pay any IRMA. The only problem is you need to be under 200 grand for 2022. And that's already happened. But if we filed an appeal and we projected your income for 2024, if we can show it under 200, then we can get rid of IRMA that was created by a prior year. So we're in these things all the time. And for a single person, that number is around 100 grand. So people that make more than 100,000, and they did in 2022, they're paying IRMA if they're on Medicare in 2024. And, again, if we can file an appeal due to a life event like retirement or a work reduction, then we can go to a 2024 projection, and then we're sitting down messing with their income and how they're receiving and when they're receiving income to get the number under that. So, Tom, can you think of where else we use this chart?
I mean, I think when someone's coming in, it's helpful to kind of know where they're at starting from a starting point. So, it's sort of a minor case that we use this, but like, what's your income? What tax bracket are you in? How much more can we fill up from there? So, but the Roth conversions are the primary place that we use this. And I mean, I have a chart sitting on my desk that has these tax brackets, and so I'm sure there's other things that are just not coming to mind right now. But I use that daily. I mean, I pull that out. I look at the charts. I give advice based off whatever the situation might be. So it's something that we use. It's just very fundamental to our practice that we do here at Cardinal.
Sure. And over here on the right is the standard deduction. So when you were talking about this married couple filing jointly, the first $23,200 they pay 10% tax on. They actually, if they're a married couple filing jointly, they're both over 65, they get a $32,300 standard deduction. And so they're going to pay zero tax on the first $32,000 of taxable income.
Well, I was going to say, I think that brings up a really good point. Is those tax brackets, those marginal tax brackets, that is off your taxable income. This is getting me maybe a little too far in the weeds, but if you look at your tax return, your 1040, and you follow it along, is you have adjusted gross income, which is essentially all your income added together before any of the deductions. Then you get to take the standard deduction and any other maybe deductions you have to get to your taxable income. The tax brackets are based off your taxable income, not your gross income. So that just really speaks to the point, Hans, that that standard deduction is you have a married couple, both over 65. The first gross income, the first $32,000 they earn, is not taxed at all. It's 0% tax on that money.
Well, it is. And for a single, that number is 16,550. So we do a lot of this work for singles. And so you just understand that people, that a single that's in the 40, 50, $60,000 range, in a combination of Social Security and other income, they're not paying much in taxes. And a married couple that's in the 60, 70, 80 department with two Social Security checks and a $32,000, they're in here and they're not paying a lot of taxes. So it may be wise to just start bringing money out of the IRA, even if we're not Roth converting it, if we're just bringing it out, paying the taxes, using it, or saving it as after-tax money for later use. So we use these things a lot. Now, I want to jump on down to the long-term capital gains. And the long-term capital gains, why don't you talk about those for a sec, Tom?
Yeah, so I mean, I think it'd be helpful first to define what these are. And so if you have an investment in a taxable brokerage account or an investment account, so something that's not a retirement account, not an IRA, not a Roth, just you go down and open an account and put money in and invest in things. If you hold that investment for 1 year, so you buy it, you hold it for 1 year, and then you sell it, you now get long-term capital gains. If you sell it less than a year, it's short-term capital gains. That really just goes back up to those marginal tax brackets up at the top. But long-term capital gains are taxed. They have a better tax rate, and so that's what we have on the board here. Is the first, and again, it's different for someone who's married and single. I'll do the married one initially, but if you're married and your income is below $94,000 and you have some long-term capital gains, that's taxed at 0%. So you have some choice in retirement of where you pull money from. So when we're creating income plans for people and we have buckets of money that maybe some IRA, some Roth, some taxable, we can pick and choose where we pull money from and really control their taxes moving forward. And we take advantage of these capital gains rates. And then even if you go above that 0%, the next one up is only 15% long-term capital gain. So if you have a high earner, they're maybe in the 24% tax bracket of ordinary income, but we can pull some money out and only pay 15% tax on it. That's a tax savings there. And so it's helpful to be able to pick and choose where you pull money from. The single filers, those numbers are a little bit less, right? The 0% is 47,000. That 15% goes up to 291. So you can see the numbers there on the board, but it has a lower tax rate than the ordinary income that you would have to pay on like IRA distributions or on short-term capital gains.
Well, another place this comes into play, people that own farmland or they just own some land and they've held it for years. It hadn't produced much income. They've paid taxes on whatever income, and now they sell it for a lot more or more than they originally paid for it. And they sell it and they have a gain of $100,000. Well, it's fortunate that's going to be taxed at a lower rate, but people a lot of times aren't ready for this. And so you're going to pay a long-term capital gains taxes on the amount of the difference between what you paid for it and what you sold it for. Rental property is another place that people own a rental house or two or 15, like some of the people that come in to see us. And now you've got what you paid for it, and then you've depreciated it over the years. And then we got to calculate what the basis is, or the depreciated value. And now you sell it. You're going to pay capital gains taxes on the whole gain. And so that's why a lot of people hold those rental properties till they pass away.
Yeah. I mean, I think passing away, you bring up a good point, is on assets that are subject to these capital gains. So properties, investments, and brokerage accounts, anything that would be subject to this tax gets a step up in basis at death. And so basis is just what you invested the original investment in. That's how they calculate the gains. They look at the proceeds you get from it minus the basis. That's your gains. That's subject to this tax. What death, those assets get a step up in basis. And so if we have this example where you have maybe land, some farmland or a rental property, and you bought it 30 years ago and you've held it all along, it's grown a lot, it's appreciated in value, and then you hold it till you die, and then your kids inherit that money or that asset, that property, they could then turn around and sell it immediately and pay no taxes on that asset. So this is really how really wealthy people, how they pass on a lot of wealth to the next generation and not being taxed. Well, excluding estate tax, we'll talk about that in a second. But they can pass these assets along, step up in basis, and not have to pay income tax on those assets.
And we plan for that with people. Well, they're still enjoying the income from it. Now, the estate tax, and one of the questions we get a lot, I get phone messages that say, I want to give away money to my kids. How much can I give them? And isn't it something like 15,000 or something? And, the answer to that is, first, we got to find out how large is your estate. And if your estate is significantly under $13 million, then you can give them all you want. Okay. I discourage people from giving away all their money while they're still alive, because they might need it. But, if you've got an estate of 1 million or 2 million or 3 million, you can give them away in any given year as much as you want. You may have to file a gift tax return or an estate tax return if you gave them away $100,000. So first thing we need to do is position whether you're somebody that has a large estate. And if that's the case, then we need to have a private conversation with you. But everybody, well-to-do, moderately well-to-do, or not having much money at all, but you want to give some to your kids, you can give each person $18,000 in a given year. And that's the new rate for 2024. So if you wanted to give your kids $10,000, go for it. Okay. If you wanted to give one of your kids $30,000 and you're married, then you can give your son $18,000 and your spouse can give your son $12,000, and you're under the $18,000. If you are single and you want to give $30,000 to your son, if he's married, you can give your daughter-in-law $12,000 and you can give your son $18,000, and you still stayed under this limit. So when you go over this limit, you got to file a gift tax return. So that's the number, is $18,000 you can give to as many people as you want.
And I think it's important. So the gift tax return, you alluded to this a little bit, as long as your lifetime gifts, at least in today's rates, is below $13,610,000, you still don't pay any tax on that gift tax return. So you file a gift tax return, essentially you're using up some of your lifetime exclusion of the 13 million, but it's still not taxed. It still has, you don't pay any taxes on that gift. And so to your point is, if you come to us and say, "Hey, for whatever reason I want to give whoever it is set amount of money." If it's above the 18, and again, like Hans was saying, you can really start adding kids into the mix. So you got a child who's married with 2 kids and you're married, you can start giving lots of money away very quickly without having to file a gift tax return. So, call us, we can help you structure that in a way. But if you do exceed those limits at 18,000 per person, then you have to file a gift tax return. But as long as you haven't used up $13 million over your lifetime, it's still 0% tax rate. So you can give quite a bit of money and still not pay any taxes on it.
Okay, so let's talk about trust tax brackets. And we go here all the time. So Tom and I are both all for trust and getting a trust when it's needed. I mean, they're like we have several clients that have special needs trusts where they have an adult child who's disabled, they got special needs, and these people are very concerned about the child or the adult child living longer than they do. And so they've set up a special needs trust, and they're going to have money put in there when they pass away, or sometimes before they pass away, so that there can be money that the child or the adult child is allowed to keep their government benefits, which are very necessary, and receive money, certain kinds of money out of this trust that will benefit the child. And the trustee will look after the child for a lifetime. We've got other videos about that. But the problem here is when you dump IRA money into the special needs trust, now the child themselves has to make distributions. So you can't have that because you're like giving the money to the child. So when it goes into the trust and then it has to be liquidated because the trust doesn't get as favorable spreading out as the taxes, look at these rates as the first $3,000 is at 10%, and then it jumps to 24% at $3,000. It's up as high as 37% at 15,000 or more. So that's a problem. And so when you're putting money in a trust, even at your death, we're going to want to structure that, if possible, so that it's a pass-through trust where the beneficiaries will actually receive the income created within the trust, and they're going to pay tax at regular people rates. Or if we have to keep the money inside of the trust, we're going to put it in some sort of a tax-deferred investment vehicle so that the trust doesn't end up eating up a lot of the values at trust tax rates, which have very small brackets. So with all that being said, we don't want to get too deep in the weeds with taxes, but just this, there's going to be a chart that we'll have in one of our videos a little later in the year when we get it from the supplier. But for now, we got to deal with the memo in this board, and the show notes is studying this from our end is really useful because it allows us to plan over several years taxes. So I want to go over a bit of what we talked about today. Is we touched on Medicare because we talked about IRMA and we talked about the Medicare tax for the well-to-do. We talked about 401ks and IRAs because structuring the distributions intelligently is a big thing that we do, and we're dancing in and amongst these tax brackets. There are no long-term capital gains tax rates on IRAs. We talked about income, and this is the income tax that we're mostly talking about. We talked about estate taxes and things you can do to plan to leave money to your heirs and to their surviving spouse. And then obviously this whole video is about taxes. So I'd like to bring Tom back on, and I want to thank you very much for listening to us. I'm Hans Scheil.
And I'm Tom Griffith. Thank you.